What's up, everybody? Wealth Squad Ace. Today, I want to talk to you about the 1% rule when it comes to real estate investing. The 1% rule is a quick and easy way for real estate investors to evaluate whether a rental property has the potential to generate positive cash flow. It states that a property's monthly rent should be at least 1% of the purchase price to be a good investment. So, for example, if you're looking for a property that's priced at 200,000, the 1% rule suggests it should rent for at least 2,000 per month, right? 200,000 times 1% gives you 2,000. This is a useful rule of thumb because it will help investors screen properties quickly without getting deep into the financial analysis, right? So you use it as a baseline to test to see if a deal is worth pursuing before you factor in other expenses like property taxes, insurance, maintenance, and other things like that. One way that you can use it to your advantage is you can compare multiple properties. So instead of analyzing every deal in detail, you can use the 1% rule to filter out properties that likely won't generate strong returns. You can use it to identify cash flowing markets. So some areas naturally will meet the 1% rule when other markets won't, right? Like areas like San Francisco, for instance. It's going to be nearly impossible to find a property that's has a good value and is able to generate that type of rent. So like if you were to find a $700,000 property, that's going to have to generate 7,000 per month for you. So that's going to be hard to do, especially with rental caps and things like that. So for some areas, it just naturally won't work, but you have a lot of other areas where you can use this rule of thumb and it will help you quickly go through these deals. One other thing that you can do is you can negotiate a little bit smarter. So if a property doesn't meet the 1% rule, you may need to negotiate a lower price to ensure rents can be raised. So you want to be in an area where you for sure are able to raise rents to at least get you closer, or you can work that deal down and get a better final deal on that property. So some limitations to the 1% rule. It's just a rule of thumb, right? It's not a guarantee. It doesn't account for local property taxes, insurance costs, vacancies rates, and all those things that will have an impact on your profitability at the end of the month. So, like I said, this is just a rule of thumb. There's many of them out there. This is a good one that I like to look at. So, if you're a turnkey investor, if you like to just get a property and you already have tenants in it, that would be a good way for you to quickly analyze the deal because you can already see exactly what the rents are able to get, especially if you have tenants there. So if the rents are below market, you might have some room to be able to raise them, but you also might need to pour some money into that deal. So, like I said, use that 1% rule to quickly go through deals. If you're looking to learn more about real estate, tap in with us in the Wealth Squad.